It is 10 a.m. in London, 5 a.m. in New York and 5 p.m. in Hong Kong. Our top stories today. Fed Chair Jerome Powell has the bond markets exactly where he wants it, lacking conviction about the Fed's next steps. Reports like this Friday's jobs numbers will be crucial for investors trying to figure out the path ahead. Plus, ECB President Christine Lagarde warns of three key shifts in the modern world and how they could impact the global economy. More from our exclusive interview. And China announcing a slew of measures to win back investors, including cutting stamp duty on stock trades. But Beijing's efforts appear to be falling flat in the face of economic worries. Welcome to Bloomberg Surveillance. Early edition, I'm Tom Mackenzie in London, stepping in for Danny Berger with Simone Foxman in New York. Simone, then, the heads of the ECB, the head, of course, of the Federal Reserve, Jay Powell, giving themselves both maximum, it seems, opportunity, at least optionality, with that focus on data dependence. Meanwhile, China coming through with some concrete measures to try and support the markets there. And as we said in the headlines, with a bit of mixed success.
Yeah, that's right, Tom, and all eyes do appear to be turning eastward this morning. Just very interested in the stimulus measures that China has announced on its economy, and that's part of why we're seeing some of this green on the screen here. Looking at S&P futures modestly higher, but as you pointed out, Tom, there was a ton of focus on what happened at Jackson Hole last week, that higher for longer message coming, certainly from Jay Powell. We're seeing a two-year yield now, just retracing a little bit of its increase from last week, hitting the highest level since 2007. But we see the dollar index still clearly indicating that hawkish policy may be ahead. We're also looking at a Brent crude that's a bit higher than it was to start the session, up about 0.27%. Perhaps some of that is based on that enthusiasm about what is happening in China and some of the stimulus that's being introduced there. Of course, if we see a stronger Chinese economy, then that's better for the price of crude that has been under so much pressure for these last few weeks.
Here in Asia, then, checking on the session how things have unfolded, because it was those measures and it were those measures that really gave that impulse around the CSI 300, the benchmark over in mainland China. And you saw a pop of around 5.5% at the start of the trading session, but that has faded significantly. The CSI 300 then closing with gains of a little under 1.2%. Again, just pointing to the lack of conviction amongst investors domestically, but importantly internationally as well. Those foreign investors continuing with the outflows of those Chinese markets, despite the flurry of policy measures announced over the weekend to try and shore up and support the equity market in the world's second largest economy. The HSI, the reflection there over in Hong Kong. The Hang Seng Index ended with gains as well of a little under 1%. But again, started much higher, faded towards the end of the session over in Hong Kong. Broadly across the Asian session then, because of course the linkages between China and many of the other important Asian economies is pretty clear, particularly on the trade focus. You did see gains across the benchmark there of around 1%. Part of it will also be a reflection of the commentary coming through from Jackson Hole. So it's a mixture of factors. Certainly, when it comes to China, the policy measures being announced, a lift, but still major question marks about whether it's going to be enough to really put a floor under those equity markets. Let's flip it on then and see how things have been playing out in Europe. Last time I checked, across the sectors, you saw technology leading the gains here, and that remains the case. 1.7%, 1.2%, I should say, for that sector. It's the chip makers here in Europe that are benefiting in the session today. Euro dollar, 108, not a lot of movement in the single currency, and bringing it back to the benchmark here across the European equities, with the note that the UK is closed for a bank holiday. Gains of 0.6%, back above 453, closing on a 454 for the European benchmark. We'll see if that momentum can continue. Really important inflation data on Thursday for the Eurozone. And think back to that conversation with Madame Lagarde, the data dependency, the importance of the data, and certainly CPI out of the Eurozone will be consequential in terms of how we build out the next steps for the ECB, particularly as we look ahead to that decision in mid-September. Simone.
Yeah, and let's get you more from that Wyoming meeting last week. Fed Chair Jerome Powell saying the central bank is prepared to raise interest rates further if needed to tame inflation. Other Fed officials also weighed in at the Jackson Hole symposium.
We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective.
At this point, we really need to see inflation moving down. And we're seeing early signs of that. but I want to keep rates where they are right now, and then we'll decide later what we do.
In my view, I think that really tightening would be a worse mistake than over tightening a little bit, because we can course correct that.
If you could get inflation down without a big recession, that'd be a major triumph for the Fed or anybody. It'd be virtually without precedent. But we're part of the way down that road, and we've been getting good news. We just have to keep getting good news.
Joining us to discuss the market reaction is Eddie Vanderwalt of Bloomberg M Live. Eddie, so it sounds like it could be a volatile week ahead. What's setting that up for us?
Yeah, you see, Simone, I think you're absolutely right. And, when central bankers say we're all about data dependency, that makes every data point an opportunity for volatility. And we've got some big data out this week. We've got the PCE numbers, we've got the non-farm payrolls. And, with every one of those data points, traders now, without forward guidance, which is what it means to be data dependent, have to reassess what the Fed might do given this particular data set. And I think that absolutely sets us up for more volatility. But you know what? I think a lot of people were disappointed that they didn't get these big announcements at Jackson Hole. But I think Jackson Hole's suffering from so much attention that the central bankers are almost a little bit worried at playing it up too much and are watching their words very carefully. So repeating their prior messages. That said, I think they are tilting a little bit more dovish than they were before, though much more hawkish than the market had expected them to be.
OK, interesting, Eddie, that's your take, that you think that marginally slightly more dovish. And yes, there is incredible uncertainty. That was really articulated, wasn't it, from the commentators on the ground at Jackson Hole, just the uncertainty that they all face. You're not seeing a lot of movement in US Treasuries today, but you're getting JPMorgan, the other bond bulls, coming out reiterating that there is value in the long end. What is your take on that, Eddie, at this point?
Yeah, well, you know what? I mean, the long end is really, I think, where we're going to see a lot of the action, because if they talk about, higher for longer, that means that inflation has remained relatively high. We're not seeing any recession. We're getting that kind of soft landing view. And then the long end will have to move a lot to accommodate that. And there's only really one way that long end rates can go from here, which is up, because we need to see that uninversion of the yield curve. So I think that's a very interesting trade that they're putting on there. I think that for that to be true, you would have to see quite an interesting development in the market, where you see a softening at the front end, perhaps driven by a recession, and then the long end coming down as well. So I think that is still very much a recessionary bet.
OK, just holding above 5% on the 2-year right now, 4.21 on the 10-year. Eddie Vanderwalt breaking down with analysis post-Wyoming, post-Jackson Hole, of course. Thank you very much indeed, and with the preview of the importance of the data coming up later this week. Turning to the ECB now, while President Lagarde, Christine Lagarde, observed on Friday that inflation remains undefeated, she did not address prospects for the September the 14th meeting. She spoke exclusively with Bloomberg.
It's critically important that inflation expectations remain anchored at 2%. If trade unions and business associations appreciate that in relatively short order inflation will be back to 2%, they will not want to fuel more inflation by having wage or margin increases that would not be consistent with that.
OK, joining us now to discuss is Bloomberg's Maria Tadeo. Maria, Jackson Hole is done. Did we get any clues on monetary policy from Christine Lagarde? I found it really interesting that she gave a bit of a nod there to the trade unions, and it's something we've heard from the Bank of England. They got a bit of pushback from that. What did you take away from the comments that we heard from the head of the ECB?
Yeah, so look, if the question is, do we know now? Do we have more information now in terms of what the ECB will do in a few weeks from now, today, compared to a week ago? I think the answer is no. But I also, as you say, I don't think that was the point of the speech that Lagarde delivered at Jackson Hole. In fact, if you take a look at the speech, the whole point of it was to almost step back from the daily tribulations of the economy, from the meeting-to-meeting basis that the European Central Bank operates, and actually take a look at the economy on a bigger picture. And in fact, what because she talked about her changes, which some of them she says are fundamental changes that are affecting the economy. She talked about the labor market. She talked about energy security, the geopolitics, just the volatile nature of the geopolitics and how that affects the economy. So I think this is more of a almost intellectual speech rather than a speech designed to talk to markets. I don't think that was the goal of it. I also think strategically, Tom, it makes sense because there's not a lot of reasons as to why she would almost point to an inclination to hike or hold when we know that deliberations are obviously still ongoing. But also, if she stresses we're about data and data dependency, it makes no sense to give a clear guidance before we get the August CPI number, which obviously we're expecting this week. So overall, I think this was a speech that had an intellectual flair to it, but also the timing. Was it right to give more clues? I don't think it is. And then therefore, we didn't get that much of an inclination, perhaps, as some were expecting. We didn't get that clear guidance.
Well, Maria, I mean, you talk about how Christine Lagarde wanting to step back from this meeting-to-meeting focus, yet we do have a meeting coming up on September 14th. How united, then, is the Governing Council at the ECB about the path forward?
Look, to me, it was very interesting in the interview that Lagarde gave the head of the ECB with Tom, that she pushed back to the idea that there is dissent in the Governing Council. In fact, she said maybe we don't get to unanimity, but we do get to large majorities. And that is always a challenge when it comes to the ECB. You're talking about 20 different economies that operate differently. But again, do we have a united Governing Council? I think the answer to that question, we're going to have to wait until that meeting coming up in a few weeks from now. We did hear the internal debate going on. The head of the German central bank said he did not see reasons for a pause. The Portuguese central banker pointed to the downsides to the economy. But one of the things that you always hear, almost a compliment to Christine Lagarde, is that she may not be an economist by training, but she is very good at building consensus. And we obviously know that it's at the end of a cycle that sometimes you see tensions play out. Can she gather a consensus? Again, we'll find out in a few weeks from now.
Yeah, that has so far been her trump card, hasn't it, as she tries to gather the different views on the Governing Council. Maria Tadeo, thank you very much indeed. We're going to have more, of course, from that exclusive interview with Christine Lagarde later this hour. Of course, you can't talk about Europe without talking about China. And in China, authorities have announced a slew of market support measures over the weekend. Bloomberg's Alan Wan joins us with the details. Alan, how consequential are these measures? Outline what we've been hearing from policymakers in Beijing over the last couple of days.
Well, you know, they're consequential for the market, but the problem is that they're not consequential for the economy. And that's the problem right now, is that people really focus on measures to support the property industry and the broader economy. I mean, as a standalone, it's a big move for the market. I mean, the last time the government cut the levy on stock trading was back in 2008, and the market soared like 9%, and it presaged a bull market rally. But this time the problem is that, you know, everyone's focused on the economy. They want to know, like, what measures are going to be taken in order to prop up the property market. Although we did see developers rally today, which is a good sign.
You know, Alan, we are seeing some of these stimulus measures going on at the same time as U.S. Commerce Secretary Gina Raimondo is visiting China. How does what's happening in the market right now play into the kinds of discussions she's likely to have with officials as she's there this week?
Well, exactly. I mean, she's going to be asking a lot about what's going on in the Chinese economy. In today's meeting with her Chinese counterpart, she sought to allay concerns that the U.S. is trying to impede China's economic progress. That said, everything the Biden administration has done in recent months, you know, would lead one to differ. I mean, the U.S. has, imposed these restrictions on advanced chips, and now it's also imposing some more restrictions on private equities investment in China. So I think Secretary Raimondo is going to have to explain exactly how the U.S. is not trying to impede China's economic progress through these measures. I guess she'll try to explain it that it's within the realm of national security to try to carve out this little niche as to explain why the U.S. is taking these measures. And of course, go back to your question, she's also going to convey concerns of a lot of U.S. businesses that are invested in China. I mean, a lot of these crackdowns in recent months, especially due diligence firms and whatnot. How is that going to affect foreign investment in China? And of course, while she's here, she might even try to figure out when China is going to resume purchases of Boeing's MAX jets, which have been postponed since 2019.
And when on the latest in terms of those measures that came through over the weekend from policymakers, and of course that really important meeting and set of meetings for Gina Raimondo on the ground in China. Alan, bring us the latest. Thank you. We're going to get more insight later this hour on China from Grace Ng, Senior Economist for Greater China at JPMorgan. We're also going to catch up with Matt Maley, Chief Market Strategist at Miller Tabak. We'll get his views on what we heard from Jay Powell and co. and how he's looking to position and why he sees potentially a correction on the horizon. Stay with us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London with Simone Foxman in New York. Now, China has long, of course, been at the heart of Apple's supply chain, with about 80% of its manufacturing partners having a footprint in the country. But the US' escalating trade war with China is forcing suppliers to diversify. That is the focus of today's Big Take. Joining us now is Bloomberg tech editor Edwin Chan. Edwin, what do we know about Apple's supply chain shifts? And this is really smart, this piece on the Bloomberg. It's only really the kind of work that the team at Bloomberg can do, you and your team, and it really is a must-read for today. What kind of were your key takeaways after all of the reporting, Edwin, in terms of how these supply chains have shifted for Apple?
I think it's widely understood that Apple's supply chain was shifting out of China gradually. But one thing that our data colleagues have managed to really prize from a decade's worth of data on Apple's supply chain was that this shift really accelerated maybe 2-3 years ago. And the main beneficiaries of that sort of seismic fundamental shift in the long term are going to be most likely India and Vietnam. You're already starting to see it. I think if you read the story, there is visible evidence of the beneficial economic impact of that move already starting to lift incomes in towns in northern Vietnam and in parts of India. And I think the local officials are really aggressive about making that happen. But ultimately, what it does is draw the clearest picture yet of this fundamental shift of a decades-old supply chain that is now, because of US-Chinese tensions, starting to fragment and starting to disperse, as it were, to different corners of the globe.
What are the implications then for India and Vietnam, especially with respect to their relationship with China? Does this make that relationship any more difficult?
I think India and Vietnam both are treading a fine line, as indeed are many other countries in the region. What is clear is that India and Vietnam have ambitions to become sort of the next China, sort of the world's factory floor, and they're putting in place incentives and programs, and their officials are, really selling the concept of basing manufacturing in these countries, both of which, India in particular, are also massive domestic markets. And I think part of the sell is that they're trying to outline how China may not be the best place to put all your eggs in one basket. We talk a lot about de-risking. I think in terms of the supply chain, the need to diversify is indeed a very real one. We saw what happened to Foxconn's iPhone City during the COVID zero years. I don't think any major brand wants to be on the receiving end of sort of volatile policy making and regulations.
Yeah. Edwin, just briefly, this de-risking obviously comes with a price tag for Apple and its suppliers. Do they then necessarily pass that on to end consumers?
I think that's definitely part of the deliberations. And in the short term, because you're fragmenting what was a very globalized supply chain and you're dispersing capacity to different countries, there will be inefficiencies and there will be cost inflation in the short term. How countries deal with that, how manufacturers deal with that, and whether or not Apple passes this cost on to consumers is the big question. And we'll just have to wait and see.
OK. Bloomberg's Edwin Chan, really smart piece of analysis on the Bloomberg and on the terminal. Coming up, 3M has tentatively agreed to resolve the lawsuits claiming it sold defective combat earplugs to the US military. But it does come with a hefty price tag. That is next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Simone Foxman in New York with Tom Mackenzie in London. Now to some of the stories we're watching this morning. FIFA suspended Spanish soccer chief Luis Rubiales over his behavior at the Women's World Cup final, which included kissing a star player on the lips. The suspension is effective immediately and will initially last for 90 days while the disciplinary committee of football's governing body conducts an investigation. Spain's National Football Association called an emergency meeting to respond to FIFA's move. Meanwhile, in other football news, Saudi Arabia is interested in discussions about joining Europe's top football club tournament, the Champions League. The kingdom has spent hundreds of millions of dollars to attract some of the world's best players and shake up the sport. And in deals news, 3M is said to tentatively agree to pay more than $5.5 billion to resolve over 300,000 lawsuits claiming it sold defective combat earplugs to the U.S. military. The settlement, spread over about 5 years, is about half the roughly $10 billion some analysts predicted 3M would end up paying.
Okay, pre-market, the stock is up on the back of that news. Coming up, Matt Maley, Chief Market Strategist at Millet Tabak, on how to position in these markets. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Fed Chair Jerome Powell has the bond market exactly where he wants it, lacking conviction about the Fed's next steps. Reports like this Friday's jobs numbers will be crucial for investors trying to figure out the path ahead. Plus, ECB President Christine Lagarde warns of 3 key shifts in the modern world and how they could impact the global economy. We had an exclusive interview with her. And China announces a slew of measures to win back investors, including cutting stamp duty on stock trades. But Beijing's efforts appear to be falling flat in the face of economic worries. I'm Simone Foxman in New York with Tom Mackenzie in London. He's stepping in for Danny Berger. We're looking at assets broadly higher this morning. But Tom, take us through what's happening in Europe.
Well, look, you mentioned the fact that we had this exclusive sit-down with the ECB President, Christine Lagarde. The importance for Europe this week is going to be on CPI inflation out on Thursday. She stressed, Christine Lagarde, the data dependency. This was a line, of course, we heard from Jay Powell as well. So as a result of that, look to CPI on Thursday for how markets start to reprice the next step. September the 14th is the meeting for the European Central Bank. Euro-dollar currently a very modest gain for the single currency, just above that 108 handle. We come back to the equity market, though, and you're seeing gains, 0.6% across the European benchmark this Monday. Don't forget the UK is on holiday, so you strip out the FTSE 100. There is the lift coming through from the action that policymakers in Beijing pushed through over the weekend. Another headline crossing just in the last half an hour or so from China, leaning on big fund managers and pressuring them not to sell stocks. So that lifted sentiment in China, not as much as some would have hoped, but you still ended up in the green in the Chinese session, and the linkages between China and Europe, and you get the uplift here of around 0.6%, trading at 454 on the benchmark. Technology is the leading sector in the session so far, 679 on that index, gaining 1.2%. We'll see if that continues in this higher rates, higher yields, higher and longer environment. Whether technology continue to push through the rates environment, Simone, is going to be really consequential. Again, that brings us back here in Europe, at least, to CPI data out on Thursday. Euro-dollar again, 108. Simone.
Yeah, Tom, that enthusiasm seeming to carry through into the U.S. session. We're looking at a little bit of green on the screen on S&P futures here, though maybe not as much as there was just a few minutes ago. Of course, we still have this impact from what happened at Jackson Hole last week. Markets weren't immediately sure, was this dovish, was this hawkish? They ultimately settled higher for longer. This was slightly hawkish. We did see two-year yields up around over 509, but now we've seen them come off slightly volatility in today's pre-market. We're looking at a dollar also that's broadly stronger. Again, that higher for longer message. We're seeing crude, a little bit of enthusiasm here with Brent at 84.72, perhaps in part because of what's happened in China and those support measures announced by the Chinese government, perhaps just simply because of OPEC's push to try and keep that oil prices high. Tom.
OK, let's go back to the analysis and the reaction from Wyoming, from, of course, the speech by Jay Powell. Former Treasury Secretary Larry Summers said the Fed probably needs to hike at least once more. Summers weighed in on Powell's Jackson Hole speech on Wall Street Week with David Weston.
I was very pleased with the speech, and I think it will reinforce the growing sense in markets that after whatever happened in 2021, the Fed had regained its bearings and was now very focused on maintaining price stability as a basis for long-run prosperity. And I was very glad to see that. And I think the strategy that was put in place a year ago in Jackson Hole, to the surprise and chagrin of many, has proven to be effective. And I was very glad to see that it's going to be continued.
OK, that was, of course, Larry Summers reacting to the speech, pleased with what he heard. Let's bring in Matt Maley now, Chief Market Strategist at Miller Tabak, joining us. And Matt, you have a view on higher for longer. How much certainty, though, do you have around what higher for longer means for this equity market?
Yeah, it's definitely creates a headwind, Tom. I just think that the situation is that the stock market was very overvalued. I mean, it got to almost 21 times earnings. Now that it's come down a little bit, it's a little bit cheaper than that, but it's still on the expensive side. And the thing is, I mean, some people kind of forget that, the Fed was always going to have to tighten, whether we had inflation or not. They had pushed interest rates to incredibly low levels during the pandemic. And obviously this huge QE program. When they ended that QE program, raised interest rates, this was something they would have had to do, maybe not to the same, well, certainly not to the same degree that they did with inflation, but they were still going to have to do it. That means that the neutral rate was always going to be higher than we saw in the last couple of years. And I just think that the stock market is now finally waking up to the fact that we're not going to return to those zero interest rate environments that helped keep the stock market so elevated. Since 2021.
Matt, good morning. We're looking at a Fed terminal rate expectations here, some of the highest that we have seen since a pre-Silicon Valley Bank's collapse. For our viewers or for our radio listeners, we have an interesting chart here showing how this has marched up consistently over time, but now they are at their highest level since March. Do you think that we have seen that the markets are adequately pricing the highest terminal rate that we're going to see?
Yeah, Simone, I do think we're getting close to that. And, that's positive to a certain degree, but it's only so positive for the stock market because, again, we're not going to return. The point really is that the free money era that we existed for so long going into 2022 is behind us. And so the Fed is going to keep those rates higher for longer. And when they do eventually cut them, they're not going to cut them back to anywhere near to the levels they did in 2020, unless, of course, we have some sort of another major crisis. And that's not going to be good for stocks either. So, again, I'm not trying to say that this is going to be horrendous for the stock market. It's just going to create it is creating the kind of headwinds that I think are surprising stock investors a little bit and are going to keep the market from really rallying a lot more from current levels, at least amongst this interest rate backdrop.
OK, so Matt, look, the equity markets may not rally much more from where we're at now. Do you still see a full-blown correction, though, Matt? I know you say that would be a healthy thing. The counter to that, of course, so some of the guests we speak to would be, look, we're getting to the end of this rate hike cycle. Inflation is looking benign. A soft landing is still plausible. Is a significant correction still in the cards for you, Matt? And does it happen this year?
I think there's a good chance we get a correction. If it's a significant one or not, I don't know. But I mean, the S&P falling 10% from its recent highs, again, that would not be the worst thing in the world. I mean, we've had this unbelievable rally this year, and corrections are normal and healthy even in the best bull markets with an incredibly strong economy. We just don't have an incredibly strong economy right now. So I guess my point is, even if we can avoid recession, that doesn't mean that we're going to return to the free money era, or that the economy is going to explode to the upside. And with the problems we see especially in China, but also now a slowdown in Europe, it's hard for this expensive stock market to move a lot higher. So in fact, I think it's going to have to come down and see a full-blown correction before we see a bottom.
Matt, where do you position in that sort of environment?
Well, I think number one, you can raise a little bit of cash, and so you can take advantage of that kind of correction. But number two, you look at Simone. You had mentioned earlier about how oil prices were remaining high, and that the Saudis. One of the reasons, of course, is the Saudis seem to be determined to keep supply at a level that will keep oil high. And if you have oil, West Texas Intermediate oil above $80. I mean, they only needed above 60, a lot of these energy companies, to make a good profit. So I think the energy sector is still a really good one. Healthcare, again, seen as a defensive sector. I think that's a good area, too. So that kind of stock rotation that we saw a lot of during August, I think we'll see more of that in the September-October timeframe.
Matt, health, energy, places to be in this environment. Matt Maley of Miller Tabak, thank you very much for joining us. Now, ECB President Christine Lagarde says the central bank is dealing with shifts in labor, energy, and geopolitics. She spoke to Bloomberg exclusively at Jackson Hole and discussed how these changes may impact the future of rate policy. Take a listen.
We are facing major shifts. I'll mention three for you. One is there's a complete change in the labor market. There's a complete change in the energy future that we are facing. And there is a complete shift in how geopolitical forces organize our economies. Not to mention in the background the climate change impact on our economies, our life, and the imperative that it becomes, as we have seen during the whole summer, for instance, in terms of major heat waves, major hurricanes, and so on and so forth. So you've got these three key shifts and the background of climate change. And we need to address each and every one of these three, which we inherited from the pandemic, which we inherited from the major supply chain disruptions, which we inherited from the geopolitical tensions that we see developing between the United States, Europe, Japan, and many other countries around the world, in particular China.
I was talking to our Alex Weber out of Frankfurt on this speech, and I want to take the 60,000-foot nature of the speech, and I can't imagine Draghi, Duisberg Trichet, giving this speech. It's original to you. But if I look at clarity, flexibility, humility, your backdrop out years is exactly the same as your backdrop on September 16th, which is the original structure you have is to pick two nations, the tension between Germany and the tension with Portugal as well. How do you get to these lofty goals given the fractious original nature of the ECB?
I would disagree with that. I think the ECB and the way it has been constructed is intended for collaboration, for controversies, for debates, but at the end of the day, for large consensus. And this is how I have been operating at the ECB. The fact that monetary policy is really European monetary policy is a plus. We are bound by the same currency, the euro. We exchange the same banknotes, maybe digitally one day.
That was ECB President Christine Lagarde speaking exclusively with Bloomberg. Coming up, China's dramatic economic slowdown in recent months is sounding alarm bells around the world. We'll be speaking with Grace Ng, Greater China senior economist at JPMorgan, next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You are looking live at the Principal Room. Coming up later today, an interview with North Dakota Governor and presidential candidate Doug Burgum. That is at 2 p.m. Eastern, 7 p.m. London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London with Simone Foxman in New York. Now, China is doing everything it can to revive its economy and boost markets. Is it doing everything? That's a question, I think. Over the weekend, regulators introduced a slew of new measures, including a reduction of stamp duty on trades and restrictions on IPOs. Joining us now is Grace Ng, Greater China Senior Economist at JPMorgan. Grace, thank you for joining us this afternoon, of course, for you this morning, for us. What do you make of these measures, Grace, in terms of how you fold them into your view on the broader Chinese economy? You and the team recently downgraded your forecast for growth to 4.8%. Do any of these measures change your view on the economy?
Yeah, thank you. So indeed, we have recently revised our growth forecast for the year as a whole. We are looking for about 4.8%, which is modestly below what the government's targets of growth for the full year, which is around 5%. And when the government announced that growth target back in March, it was actually seen in the market as quite a conservative one. But given the magnitude of slowing in the economy in recent months, even that 5% target now seems to be quite challenging. Whether the recent policy moves will change that, I think, to be fair, when we make these recent forecasts, we have factored in some moderate policy support, as already indicated by the government, for instance, in their Politburo meeting in late July, as well as a series of other high-profile policy documents and announcements. So, yeah, indeed, I would say these latest moves are in line with what we have been looking for, basically modest pace of policy support. But in terms of what the magnitude of the economy's move going into second half, we are assuming a sequential growth trend at somewhere between 4.1 to 4.5% on a quarter-on-quarter basis, which brings your full year growth to 4.8. We are pretty comfortable with that forecast.
Grace, look, you'll be well aware there are voices calling for the big bazooka, for fiscal stimulus, for additional measures, particularly aimed at the consumer in China, the consumer that has been so badly pressured by the lockdowns around pandemic and the lack of generosity. How much room for manoeuvre does the finance ministry in Beijing have? How much dry powder do they have, the fiscal space for China's policymakers?
Yeah, indeed. I think one of the surprise of the somewhat slower pace of recovery in the economy and particularly consumption in China compared to the rest of the world, especially in DM economies, in our view, is exactly because the Chinese government, quite unlike the DM governments, has been quite cautious about the fiscal support that they come up with to support the household sector, especially the middle to lower income households who have been badly affected during COVID. So while the middle to high income households actually do have excess savings coming out of COVID, the low income households are still in the struggling to regain their job, to rebuild their savings, and then to increase consumption down the road. So in that regard, yeah, there has been a lot of policy push to, for instance, the government to come out with a larger scale consumer coupons to the households at large, or some kind of fiscal transfer to support the lower income households. To be fair, China's policy room has become somewhat more limited, given we have several rounds of stimulus, starting out from the 2007-2008 4 trillion stimulus, as well as following rounds of support. So in our estimate, by end of last year, China's total public sector debt to GDP ratio has come up to about 95%. So in that sense, yes, the room for support is less than before, but some kind of moderate support in the form of, say, consumer coupons is still, we do think, is manageable. But
Right.
The issue is more the government's thinking of policy support typically more falls on the investment side, on the corporate side, rather than directly on the household side. So it will be a significant change of mindset or the format of policy support from the Chinese government point of view.
Can I cut in there? Do you see the entirety of the pain for consumers that's come from some of these housing woes? Do you see that has fully translated into what people are feeling, or do we have more ahead? Is there worse that people could feel here?
Yeah, actually, the restraint on consumption or the drag on the general household consumer confidence comes from a couple of areas, including the overall economy's slower than expected pace of recovery, including the young graduates' difficulty of getting jobs upon their graduation, as well as the slower pace slowdown in the housing sector and the impact on the financial sector, LGFV, and so on. So in that regard, the drag on the consumption side comes from different sources, and the wealth effect coming from the slowing in property sector and declining in property prices is clearly one of them as well. And in that regard, yes, it is worrying that if you do see further signs of decline in property prices, for instance, then you could have additional drag coming from the wealth effect on the household sector.
Yeah, a lot to keep an eye on there. Grace, thank you so much for joining us on an important week for China and the Chinese markets. Thanks to Grace Ng of JPMorgan. Now, coming up, a look at some of the market-moving events to watch throughout the week. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London with Simone Foxman in New York. Quick look now at what is ahead this week. US Commerce Secretary Gina Raimondo continues her visit to China as part of the Biden administration's effort to lower tensions between the world's two largest economies. Then on Tuesday, UK Foreign Secretary James Cleverly is expected to begin his visit to China for talks on Russia and Ukraine. And we get euro area inflation figures, and the ECB publishes an account of its July meeting on Thursday. Also on Thursday, UBS releases the first set of results since taking over Credit Suisse. And we end the week with the August US jobs report. Plus, Bloomberg will be live in Ternopil for the Ambrosetti Forum.
Thanks, Tom. Now a look at some of the stocks we're watching in pre-market trading in the United States. First, 3M, which is said to tentatively agree to pay more than $5.5 billion to resolve over 300,000 lawsuits around defective compact earplugs it sold to the U.S. military. But that's actually about half of the $10 billion or so that analysts were predicting. So we can see shares popping in the pre-market on the back of that news. Also, Better Home and Finance. This is an online lender. It combined with Aurora Acquisition Corp and plunged on its first session after the SPAC combination closing. It was initially announced May 2021, took more than 2 years to be completed. The market's not super hot on this morning. We're also watching some Chinese stocks trading on the back of that news for support for the Chinese equity markets. In particular, NIO, Xpeng shares a bit higher this morning. Some of this enthusiasm, even though it's faded in China itself, seeming to come through to the U.S., Tom.
Yeah, I think it's worth noting as well with Xpeng and NIO, a slightly different line coming through for those two companies. The news that Xpeng, which is a major startup in the EV space, has bought some assets from DD and the stock popped on the back of that. But you're right, more broadly, the policy measures coming through from China, really remarkable in terms of the upside and then the fade. The concerns continue for that economy. That is it for the early edition. Surveillance is ahead. This is Bloomberg.